All right, the next question came in from Sam. Sam said, I'm worried about taking too much risk. How can I minimize risk with my investments? So this is quite a common question and completely understandable because investments can be scary. If you look at the news kind of on a weekly basis or a daily basis, you'll see the share market went up, share market went down, like people lost their money or people made money. Like it can be a little bit scary. So completely understand. Simplest and easiest way to reduce your risk while still investing in something appropriate for you is diversification. That is one of the easiest ways to minimize the risk. And so diversification is investing in multiple assets. So rather than picking one, as mentioned earlier, picking one fund, one Australian company, single share, and investing in there, you're solely reliant on what's happening with that one company. Whereas diversification means you have some money in Australian shares, some money in international shares, some money in Australian property, international property, maybe emerging markets. I'm not throwing around a few different terms here, but if you do a quick Google search of like, what are the top Australian shares? What are the top international shares? What are Australian property funds? What are international property funds? What are emerging market investments? So you start to spread your risk over different assets and different investments. So if the Australian share market goes really well, but the international share market goes down, you're what's called hedging your bets between the two. If the property funds go up, but the Australian share market drops, it kind of balances out that risk a little bit. So that's one option. The other one is to spread your risk over having some money in cash, so having that money in savings. So always making sure that we have that emergency fund, of course, before we start investing. But having that money, some money sitting in cash, maybe some money in a term deposit, some money in shares, potentially some money in property if that's possible, some money in bonds. So you're spreading your risks across different asset classes, and you're also diversifying as well. So this reduces the risk down. So similar to what we spoke about in the previous episode, where we have defensive assets and we have growth assets, we can balance your risk across the two, so to help reduce that risk, but still making investments. So rather than just leaving all of your money sitting in a savings account that's not really going to go very far, you're still taking investments, but you're reducing that risk. As we've said all along, it's having those goals, understand what those goals are, and then how much risk do you need to take is one question, and how much risk are you willing to take? So how much risk you need to take, you never want to take more risk than you need to. So if you've got a super simple goal or a super simple investment strategy that you only need to do this amount of investments over X amount of period of time, if we don't need to take much risk, then there's no need to take that risk. So we want to make sure that we're balancing everything to align with the goals, but also align with your risk tolerance. So hopefully that's helpful. Thanks, Sam.